If your household income crossed $218,000 in 2024, Medicare is charging you an extra $540 per month right now, on top of your standard premium, and they were never required to tell you before it started. That is $6,480 this year alone, for coverage that has not changed, for income that may have come from a single financial decision made 2 years ago and will never happen again. Before I walk you through exactly how this works, I need to tell you about one specific move that millions of American retirees have made in the last few years on the direct advice of their financial planners. It is widely considered one of the smartest retirement strategies available. Done at the wrong income level in the wrong year, it quietly triggers this rule and adds thousands of dollars to your Medicare bill 2 years later, with no warning and no notice from anyone. I'm going to show you exactly what that move is, and I'm going to show you how to find out whether it has already cost you this year. The rule is called IRMAA. It stands for Income-Related Monthly Adjustment Amount. It is a surcharge that Medicare adds to your monthly premiums when your income exceeds a specific threshold. It applies to Part B, which covers your doctor visits and outpatient care, and it applies to Part D, which covers your prescription drugs. Both bills go up at the same time. In 2026, the standard Medicare Part B premium is $203 per month. Most people on Medicare pay exactly that. But the moment your income crosses the first IRMAA threshold, your Part B premium jumps to $284 per month. At the second tier, it climbs to $406 per month. The tiers continue upward from there, all the way to $690 per month at the highest bracket. Each tier is a cliff, not a slope. $1 of income above the line, and the entire surcharge applies. For a married couple, where both spouses are on Medicare and both hit the second tier, the additional charge is $406 per month per person. Combined, that is $812 per month in Medicare surcharges, before prescription drug costs are added, nearly $10,000 per year. For the exact same doctors, the exact same coverage, not one additional benefit. But here is what almost no one explains when they describe this rule. And this is the part that makes IRMAA genuinely dangerous for people who are not actively tracking it. Medicare does not look at your current income to set your tier. It looks at your tax return from 2 years ago. That means your 2026 Medicare premiums are based on your 2024 modified adjusted gross income, not what you are earning today, not what you earned last year, what you reported on your federal return 2 years ago. For most retirees, this creates a direct and painful mismatch. You could have fully retired in early 2025. Your income this year could be $40,000. But if something happened in your finances in 2024 that caused a spike in your reported income, Medicare is reading that spike right now and billing you accordingly, even though that income is completely gone, even though you have no way to go back and undo it. There is no automatic correction. There is no letter that says, "Your income has dropped since we ran this calculation." Medicare issues an IRMAA determination at the start of each year, based on the tax data the IRS shares with them. And that determination stands for the entire year unless you file to challenge it. Therefore, the group most likely to be overpaying IRMAA surcharges right now is not the wealthy. It is recent retirees. People who had one large income event in 2023 or 2024, whose income has since dropped to a fraction of what it was. And by far the most common cause of those spikes is the transaction I told you about at the start of this video. The transaction is a Roth IRA conversion. A Roth conversion is when you move money from a traditional IRA or 401k into a Roth IRA. The money grows tax-free inside the Roth, and qualified withdrawals in retirement are not taxed. Financial planners have been recommending these conversions aggressively, particularly to people in the decade before retirement, as a way to reduce future required minimum distributions and manage long-term tax exposure. The recommendation is often exactly right, but a Roth conversion counts as ordinary income in the year you execute it. If you converted $100,000 from a traditional IRA into a Roth in 2024, Medicare sees $100,000 of additional income on your 2024 return. For a married couple whose income was otherwise below the IRMAA threshold, that single conversion can push them from the standard rate to the second tier in one transaction. The result is that Medicare is now charging them $812 per month in 2026 instead of $400. That is nearly $5,000 extra dollars this year for a conversion they made 2 years ago. For money that is now locked inside the Roth, and cannot be touched without consequences. That is not a penalty for doing something wrong. That is the rule working exactly as designed, and it will run for the entire year unless you file to stop it. Roth conversions are not the only trigger. There are 3 others that hit seniors regularly, and that almost no financial planner thinks to mention before the transaction happens. The first is a home sale. If you sold your primary residence in 2024 and your profit exceeded the capital gains exclusion, which is $250,000 for a single filer and $500,000 for a married couple, the excess was reported as income on your return. Medicare is reading that number right now. The second is required minimum distributions. Once you reach the age at which IRA withdrawals are required, those distributions count as income. If you inherited an IRA in 2024 or took a larger distribution than usual for any reason, it is sitting on your 2024 return and it raised your tier. The third is what I call the combination trap. Social Security benefits are not directly taxed, but up to 85% of your benefit becomes taxable once your combined income crosses certain thresholds. When you stack that on top of pension income, investment income, and IRA withdrawals, your reported income can be significantly higher than you expected. 1 year where multiple income sources land on the same return is often enough to push a household into the first or second IRMAA tier. Now, I want to come back to the number I told you about at the opening of this video, because the numbers in this rule are not approximate. They are exact, and you need to know where you stand. For a single filer in 2026, below $109,000 in modified adjusted gross income, you pay the standard rate of $203 per month for Part B. Between $109,000 and $137,000, you pay $284 per month. Between $137,000 and $171,000, you pay $406 per month. The tiers continue upward from there. For a married couple filing jointly, every threshold doubles. The Part D drug coverage surcharges stack on top of each tier. At the first tier, $14.50 per person per month. At the second tier, $37.50 per person per month. These numbers compound. A married couple at the second tier for both Part B and Part D is paying over $940 per month combined. The standard rate for that same couple is just over $400. The difference is $540 per month, $6,480 per year, for coverage that is identical in every respect to what they were paying for before. But here is something Medicare does not put in the notice it sends when your premium goes up. You can appeal this determination. And if your income has genuinely dropped since the year Medicare is reading, there is a strong chance the appeal will succeed. The Social Security Administration handles IRMAA determinations. If your income dropped because of a qualifying life-changing event, you can request that Medicare recalculate your premium using a more recent income estimate. The form is SSA 44. It is available at ssa.gov at no cost, no attorney required, no fee to file. The qualifying events include retirement or a significant reduction in work hours, the death of a spouse, divorce, loss of income from a rental property, loss of pension income, and certain employer settlements. If any of those events occurred after the tax year Medicare is currently using, you submit Form SSA 44 with documentation showing your current or expected income, and Social Security will recalculate. The recalculation is not automatic. You have to file the form yourself. Thousands of seniors overpay every year because they received a higher premium notice, assumed it was correct, and never challenged it. The SSA does not call you. They do not follow up. The form has to come from you. Therefore, if your income drops significantly between 2024 and today because you retired, because a spouse passed, because a rental was sold, or for any other qualifying reason, filing Form SSA 44 is the first thing you do after this video ends. If you have not yet hit the threshold, but you are planning a Roth conversion, a large IRA withdrawal, or a real estate sale in 2025 or 2026, model the IRMAA impact before the money moves. The conversion you execute this year becomes Medicare's calculation 2 years from now. A planner who walks you through a conversion without showing you the 2-year Medicare impact is giving you half the picture. And if you have been meeting with a financial advisor for years, and the word IRMAA has never once come up, that tells you something about the kind of planning you have been receiving. Here's exactly what to do right now. Pull up your 2024 federal tax return. Find line 11 on Form 1040. That is your adjusted gross income. Find line 2A, which shows your tax-exempt interest income. Add those two numbers. The result is your modified adjusted gross income for IRMAA purposes. That is the exact number Medicare used to set your 2026 premiums. If that number as a single filer is above $109,000, you are in a surcharge tier right now. If you are a married couple, and your combined number is above $218,000, you are in a tier now. If you qualify for an appeal because your income has dropped since 2024, download Form SSA-44 at ssa.gov. File it before the end of this year. ssa44.ssa.gov.